Hey, this is Mark from RightLine, and I just wanted to say a couple of quick words about Lee. Normally we don't share webinar time, but I think they have great software at Job, and the thing about Lee is he is just so open, honest, and transparent that it's really a pleasure to work with him in this industry where everybody's touting all kinds of crazy numbers and figures. These guys are not going to tell you what you want to hear. They're going to tell you the truth, and that's really, my my history of working with them. So just let me go into our quick disclaimer that that we're an educational service, and that there's just a considerable amount of risk trading futures and forex. And we're not financial advisors. We're not licensed commodity trading advisors. We recommend that you always talk to a licensed broker before making any investment. And no registered subscriber to RightLine is permitted to hold or impart the copy, sell, reproduce, transmit, or display any information or materials related to RightLineTrading. Now, just a little bit about my background. I'm a graduate of the University of Pennsylvania. I'm a former professor at Jefferson University in Philadelphia, PA. I've been involved in the financial markets for over 20 years and began trading the futures and forex markets about 10 years ago. And for my thesis, I was involved in mathematical modeling using multivariable equations. And back then what I did was we did mathematical modeling for the physiological parameters that underwater divers were subjected to when they did decompression. It's a very, very laborious process, and back in the elder times when I was doing my graduate work, this was like a cutting edge type of science. The Navy used to just bring people up from deep dives. There's an inert gas mixed in with oxygen and nitrogen, and they have to take pit stops in order not to get decompression sickness. And it was all done by trial and error. And for the first time, what we did was we determined all the independent variables that go into creating underwater decompression sickness, optimized those using mathematical modeling, and came up with a really best guess via the mathematical modeling for deep dives. And when I became involved in the futures and forex markets, I looked upon all financial instruments as a closed system that can be described just similarly to any other closed system via the use of multiple independent variables optimized in a multivariable equation, the ultimate goal of which is to be very predictive of future price, so that you can determine how future price moves. Now, in order to do that, you have to determine what are the relevant independent variables, which is something that very, very few software developers even think about. You can't start building a multivariable equation until you're sure that you don't include dependent variables. So without really getting really complicated here, what we've done at RightLine is via the use of an enormous amount of forward testing, via the use of 2 years of forward testing, determine what we believe to be the critical independent variables that are critical in determining the future price movement of any financial instrument that there is, optimize them, and that's how we've come up with our indicators. Now, what we've done is we wanted to make one trade configuration that we found was the most profitable trade, in which over 85% of the entries are winners, with really a superlative risk reward. Now, the thing about risk to reward is that, I have people send me emails all the time about, why isn't the risk to reward on a trade that we take? Why isn't our automated trade management strategy, or our ATM, better? Well, the fact of the matter is, you can't make your reward higher than the market's going to give you based upon your mathematical analysis of its volatility. I mean, you can ask crude oil to give you 25 ticks on a trade, but it's very rarely going to do that. So it's going to hit your trailing stop or whatever your targets are, and you're never going to get to where you want to be. Now, in terms of your stop, we have devised a really excellent way of diminishing risk. In this particular trade, the risk to reward, for every dollar you risk, you have the potential to make 3. And the fact of the matter is, that 3 is not just put there. I could put the risk to reward as 5, or the risk to reward is 8, 1 to 8. But the 1 to 3 is a very, very reasonable number, and the one that we found will hit for you on many of your trades. And what the trade does is it leverages the direction of institutional money, and 2 contracts can easily make you $500, which is really unusual for that low of a risk. And it does more than leverage the direction of institutional money. I'm going to show you the other key parameter that it leverages. Now, remember we talked about what are the independent variables that go into determining the movement of any financial instrument. And it doesn't matter whether it's futures, stocks, or Forex. If the independent variables are truly independent, they're going to work on any financial market or any financial instrument. It doesn't have any bearing on the sensitivity and specificity of the trading entry as to what you're trading. It's irrelevant. If it is relevant, then those are not true independent variables. And I see software all the time when you have to trade the NASDAQ or you have to trade crude oil. Well, if they're instrument dependent, then the software is not truly operating on independent variables. And the one thing that we don't do is use any indicator that assimilates data from your trading chart. If it does, it doesn't have any future predictive value. It tells you where the market's been, but it doesn't tell you where the market's going. And we have looked at the oscillator, which we have discarded. All the oscillators, relative strength, stochastic, the CCI, the Williams %R, they don't work. And that's why, to say really quickly, every generation of day trader has the same failure rate. About 85% of all day traders not only don't make any money, they go bankrupt. And the reason that is so is because they all follow the same dogma that's been taught to the previous generation, and they never wonder, well, you know, these guys who are teaching me are the ones that are going bankrupt. So there's no process by which anybody questions all of the information that they're taught. And if you look if you do a scientific, if you do a world literature search, you can do a Nexus Lexis search of the world literature looking for scientific studies that determine the precision of an oscillator or the MACD in getting a trading entry, and you will find nothing. All the information that you've been fed is all the information that has been fed to an infinite number of day traders prior to you, and they're all bankrupt. So let's just all discard the information that you've learned. And Fibonacci is another big myth. And that's really not the purpose of this webinar. But what we're going to look at are true independent variables that are truly going to determine the price, are going to determine the direction of your trading instrument. Now, what we're looking at here is our bias indicator. And what our bias does is it forms, the best way to describe it is this. The best down bias is pink. Pink means that the two higher time frames, and I'm going to look at the questions at the end. That's why I'm trying to move as fast as I can, because there may be a lot of questions, and I want to familiarize you with the trade configuration and then have a chance to answer all the questions. So pink occurs when your two higher time frames, not anything from your trading chart, are moving to the downside. And what does move to the downside mean? It means that the 50 simple period 50 period moving average, then that's a simple, is moving to the downside. Our 15 period proprietary moving average is moving to the downside, and all support to the downside on your two higher time frames is broken. So obviously, when you get pink background bias on your trading chart, you're very likely to have price move down on your trading chart because your two higher time frames are pulling it down. So the pink background doesn't occur because price falls. Price falls because the background is pink. Now, and that's a true independent variable. The price on your trading chart doesn't move it. It moves the price on your trading chart. So this color background bias is one color that we need in order to take a transition zone trade. We want to leverage the direction of the two higher time frames. Secondly, what we look at is we look at correlative markets. Now, I think it's pretty common, it's common knowledge that what institutions do, for the most part, is they have a fixed amount of money they play with during the day. And there's always a risk on, risk off scenario. So when risk is on, they're going to put their money into stocks. They're going to put their money into higher risk investment vehicles. When risk is off, they're going to move to bonds. They're going to move to notes. They may move to precious metals. They may move to currencies. So there are correlative markets because all the institutions are doing is rotating the money around into the different investments, into the different investment markets, depending on their perception of risk. So what we did was we looked at what, in this particular case, we're looking at bonds, and we found 6 correlative markets, 3 in each green line. Now, the market can either move up when bonds move up, or it can move down when bonds move up. I mean, to give you a good example, and we don't really give away what those 6 markets are, because that took us such a long time to determine. Now, the correlation coefficient has to be 0.7 or greater. So 70% of the time, and as much as 90% of the time, a market will either go up when bonds go up or go down when bonds go up to make it into this quant line. And that's why we called it the quant line, because each individual market that's embedded in the line are quantitatively weighted based on their correlation coefficient. And what this really is all about mathematical modeling to optimize the precision of a trade and get you an entry that has a real high positive predictive value of at least making you something, and also the potential of giving you a home run. That's a great trading entry, and that's what really we configured on the transition zone. But getting back to this particular indicator, when you have dual green quants, and we have 3 quants on the E-mini that we trade, on 9 correlative markets, we know that, for instance, bonds and treasury notes, ZN, have a real high correlation coefficient. So one of the markets in these lines are notes. So when bonds go up and notes go up, and I can tell you now that certain currencies also correlate, and also stocks have an inverse correlation. So what this is telling you when the lines are green, green, is that money is flowing not just into bonds, but also into its correlative markets. And the institutional guys are only going to create these dual greens or dual reds when there's a mass participation by a huge amount of money moving from one asset class to the other asset class, i.e. from low risk to high risk or high risk to low risk. So you can see that on dual greens, there's a strong predilection for bonds to rise. Because, and remember, in these lines are not bonds. They're only its correlative markets. We don't use any information off the trading chart we don't use any of the data from the trading chart to create the color of the indicator, because that's a dependent variable. We don't want to stick that in there. We want the independent variables to move price on your trading chart. So when you have dual greens, the likelihood of bonds rising is exceedingly high. And you see that it happens right here and here. I didn't cherry pick this. You're going to see on the platform that when you have dual greens or triple greens, or in the case of gold and crude oil, we have only one quant line, because we couldn't find that many correlative markets. When they're green, there's a strong predisposition for the market to go up. Now, that doesn't give you an entry. It just gives you a bias. It tells you the direction to trade, because you always want to trade in the direction of institutional money. And I'll just tell you this, if you're just formulating your trading strategy, you should never counter trend trade. If you try to counter trend trade, you are bucking the institutional money and you are going to wind up going broke. You must trade with the trend, because when there is a trend, it is created by the big guys with a lot of money. And see what happens when the correlative markets go yellow, yellow, and they're all moving in different directions? The market breaks down into chop. It just becomes untradeable. But when with the application of money, the market begins to trend. And I'm just going to give you my quick law of thermodynamics as applied to the market, and that is the market is, I always wondered, why does a market have chop? Like, who's trading this crazy stuff? I mean, why are people going short and going long, and it seems like they're trading in random fashion, and it looks like nobody is set to make any money in this type of environment. Certainly you or I are not going to trade chop, and it's very, very critical for the software to clearly define chop, because chop has to do with prevalence, and prevalence is directly related to the precision of a trade. And that's because the market, like any other closed system without the application of energy, which in this case is money, moves to a state of maximum randomness. That's a law of thermodynamics. If you have kids and you look at their room, if you don't apply energy to that room, clothes just go flying all over the place and it becomes a wreck. Then when you go in there and clean it up, that's the application of energy. In the markets just trade and chop. When institutions bring huge amounts of money to bear, that's the only time the market's going to trend. And that's the time to trade it. Now, the other thing that we must do is we must trade in the direction of the 50 and the direction of the 15. Remember, we are trend traders only. And what the trade configuration that we're going to look at leverages is also market structure. And market structure really is the icing on the cake that really gives you the entry. When you know your bias, then you have to determine a specific entry, because you can enter on a 10-tick stop, get wiggled out of the trade, and then have the trade go 60 ticks in your favor. You have to make sure that you're entering at an optimal time. And what we look for is market structure to help us determine that specific entry. Now, consolidation is a great formation, which the software reads. I'm going to show you that. And what happens in consolidation? First of all, you have all these red candles with a predominance of sellers, they're trading into the trend. Then you have all these counter trend traders. They're trading against the trend. These are the guys that are going to get killed. But for some reason, they've decided, based on divergence, based on whatever system that they're using, they're going to counter trend trade. Well, consolidation almost always breaks out in the direction of the trend if the market isn't oversold or isn't overbought. And so we're going to take a transition zone trade on a breakout of consolidation in the direction of the trend. And a breakout of consolidation is a real powerful trade because the market's breaking out not only on the addition of new sellers, but it's breaking out on the fact that you're stopping out all the buyers in these counter trend candles. So the longer the consolidation lasts, the more traders you trap in the counter trend direction, the more thrust the trade is going to have when it pushes through and breaks out of consolidation and squeezes all these long traders. And trust me, they're going to get squeezed. Very rarely do you get a breakout of consolidation against the trend. Now, here's a transition zone trade. This is a 17.5 point trade on the E-mini. Now, what we're doing on the transition is we're leveraging two things. First of all, in order to get a transition zone, the quant lines, all the correlative markets have to be telling you that money is being sucked out of the E-mini and going into its correlative long markets. Now, this black line I didn't draw in. This is a system-generated line. And every time there's a transition zone, the line appears and it tells you that our automated algorithmic transition zone system is looking for an entry. Now, what it wants to do, we know that the higher time frames are moving to the downside. So the best time to get in is on a pullback against the trend of your two higher time frames. So it's going to enter you on the first retracement or pullback on a short trade to resistance because it knows that the likelihood is this trade is going to go all the way down. And that's exactly what happens. So the transition zone entry is the first pullback against the two higher time frames. And it must evolve fairly rapidly. It only has 5 candles in order to get that pullback for you to get an algorithmic automated entry. And it's got to be the first retracement. If you notice here, you get a move out of consolidation. If you don't get, if you're on the discretionary system or for some reason you miss it, you can still get in here out of consolidation. Or you can get in here on the C candle. But the fastest and earliest entry is when all 3 of the quants are red and you're leveraging this pink background bias and there's no downside resistance to the trade on your trading chart. And that's a monster trade. With 2 contracts on very little risk, you make an enormous amount of money. And remember, if this trade goes 2 or 3 in your favor and then comes back, the automatic stop is on a reversal candle. So if you get an up candle here, the initial risk is 6 ticks. You're only going to be taking 2 or 3 ticks of risk on an initial on a 5-tick stop where your potential downside is enormous. So your risk to reward is huge. Let me show you a little easier one. Now this is on crude oil. Now they come, the stronger they come, the best is when the pullback is on the transition zone. You can see that price is really trading sideways on your trading chart. But all of a sudden, the 2 higher time frames click in. And they're all of a sudden locked to the downside. All resistance to the upside is broken. and you're on the trading chart, you're in a retracement. The system will get you in on the first retracement and take you on a 15-tick stop all the way up for 61 ticks. Now, there are a bunch of exit criteria. The worst that can happen to you on this trade is you're going to get stopped out on a 15-tick retracement. But there's a very big trailing stop in order for you to capture this huge move. The first target is 7 ticks. You lock in 7, you got $70. At the time, your stop is at 10, so your maximum loss is $30. When you get to 10 ticks, your stop goes to -5, and your maximum win there is $20. So if you get a 10-tick move, you have enough for your commission at a McDonald's hamburger. And then if you get a runner, you can get 61 ticks on a very, very lenient trailing stop. And here's another one. This is there's the system telling you the algo is on. There's no downside support to stop you on your trade. It goes 34 ticks, and based on the 2-contract protocol, you make $360 on really, really small risk. All the trade's got to do is go 2 or 3 in your favor, and you're at risk for only 2 or 3 ticks on the trade. That's a very small risk. If it goes immediately against you and doesn't go 1 tick in your direction, your maximum loss is $150. Max. But you usually get at least a tick or 2 in your direction, and you usually get a winner 85% of the time. Now, before I go to here, I just want to show you a couple on our trading chart. Let me move these out of the way, and hopefully you can see our chart. I'm just going to ask Rory to make sure you can see that. Okay, he just yelled yes, so I know you can. So let me just move this over. And here was a transition zone trade we had today in the trading room. And you see right here. Now, we don't have the black line anymore because the black line skips across the chart as you get different transition zones. It's not an indicator. It's an algorithmic. It's the on switch on the algorithmic chart. But you come down. Here's your quick retracement into the right at the start of the zone. All 3 of your quant lines are red, meaning that all of the correlative markets are pulling money out of the E-mini into its correlative representatives, and you'll see it gave us some heat. It went 3, came all the way back, and then dropped 10 ticks. And I think it made us $175. Not an enormous amount of money on the trade, but a really nice amount of money given the fact that we're risking so little. Now, I don't want to complicate things, but this is an algorithmic entry. This has a completely different set of parameters and criteria. It's also a system-generated entry. It's different than the transition zone, and this one got 20 ticks. But I don't want to confuse it, but it's on there, and I just want to show it to you. Here is another transition zone, right here. The zone starts here. Right here, actually, on the I can't get the line to go right there, but right there on this candle. And then here's the first retracement early on. And on crude, this one went 22 ticks. And this is a trade that I took in the room. It went an additional 14 ticks. So what we're leveraging is a pullback against the longer-term time frames, and we know that pullback's not going to last. It's a pullback into resistance. Correlative markets are heading down in your direction. We know where money flow is heading. We want to get into this trade as soon as we can. After the transition zone has moved 5 candles, if the transition comes on the 6th, the algorithmic will not take the trade because the transition zone's too mature. We want to get it early, right when the higher time frames have crossed to the downside and your trading chart is either moving sideways or moving up, because that's not going to last. Now, I want to go back to the slides. Here we go. And just give you the criteria. It's nothing you really have to remember, but it's an early retracement after the transition zone. The background goes to pink or green. Enter on the first retracement. After the entry, your first target is 7. Your initial stop is at 10. Remember, you're going to stop on a reversal candle. If it's a short trade, you're going to stop on the first up candle close. If it just goes a few ticks in your direction, the system will take you out well before that 10. And that's on crude. On the E-mini, your stop is at 6 ticks. First target's hit, $70. Stop is at minus 10. Price it's 10 ticks. Stop goes to minus 5, and then trails the trade all the way by 15 ticks. Now, the exit criteria are this. The 15-tick trailing stop is hit, or upside or downside resistance or support is hit on your trading chart. And if it is, the algorithmic system will exit the trade for you. It does not make the supposition that upside resistance or downside support will break. If it doesn't break and it bounces, it's going to cost you 15 ticks. So it's going to take you out at upside resistance and downside support. Or if the modified 15, which is our proprietary 15-period moving average, turns yellow, the trade also ends. So it's not also going to give that 15 ticks a chance to come back and cost you $150 on your trailing trade, on your trailing stop. It's going to try to get you out faster. So let me just show you a quick video of a trade. Now, I just made this today, and I have to tell you, it's really a terrible video. I got to find it. And it's, you know, it's a live trade. Let me just go to my desktop. My desktop. Here it is. Now, now hold on. Okay, now what happened? Let me stop. Oh. Now you hear that order pending, order filled. What happened was when the video somehow was rendered, all the audio got stuck at the beginning, and the trade hasn't even started yet. So you're going to hear all that noise clanking around. It's just ahead of the video. But I'm going to move through this video really quick. We'll get past that. Now you can see this is market replay of a live trade. Now let me just move it over. I don't waste time here. You'll notice the quant line is red, and we're trading crude. Now there's the algorithmic signal that tells you that the system is looking for a retracement, and will take a retracement as long as it's 5 ticks or less off of resistance to the downside. And you see the system has just turned on the signal. That NDT.S tells you short. That's the Ninja Dome trader that we've made, that we have a patent pending on, is already looking for the trade to go short. Now notice nothing's happening because for some reason we have no entry, and I don't know why it worked this way. But you can see it occurred 1, 2, 3, 4 on the 5th candle. That's the maximum allowable. Now, if you look at the dome, it just jumps. And I don't know why it does that. But that's just the way the video came out. And if you hang on 1 second, it's going to move now. I just didn't have time to redo it. And it was so frustrating. So now it's on 10 ticks. And once it, and I don't know if it moves smoothly or it's just going to jerk along. No, there it goes. Now it's up 21. Now it's up 29. And this is an automated entry. You can see it's an entry out of consolidation. This is also, that X means it's a strategy entry. So it's 2 system-generated entries on this transition zone entry. And they are very powerful retracements into a confirmed trend in which the money is flowing out of crude oil. Now, this is supposed to be, now it's up 33 ticks, and that's where it stops. Now, I think the trade went 33 or 34, and then you can see the modified 15 is still red. No reason to end the trade. There's no downside support to break, no reason to terminate the trade. So it just came back all the way on a 15-tick trailer, and you got 14 ticks on the runner. Now, that's not to say you can't take this trade out anytime you like, just simply by stepping in and closing the trade. You can do that. If you want to take $300 on the runner, you can just step in and close. But you may lose a 50 or 60 tick trade. So you do that, you know, at your own peril. But the trade made, let's see, it made $210 because there was no reason to close the trade early, and it cost you that 15-tick trailer. But that is not bad. And then once this trade hit, it went down like a rocket ship. And a small retracement and then a continuation right back into the trend. I'm sorry that wasn't a better video. So that's really the system. I don't want to, let me just quickly answer questions about it. Also, it's very inexpensive. And let me just get questions here. Okay, hang on. All righty, hold on 1 second here. Okay, I think that's a question for Lee. Yeah, that's for Lee. All right, still for Lee. Our system works on any kind of bar. It works on range, Renko, tick, time. Remember, if it's bar dependent or instrument dependent, it's not running on. It's not a true independent variable. All you're looking for is a retracement into a confirmed trend with the quant lines in your favor, and you must have the background. That background will come. Your 2 higher time frames will converge into a down or to an up. And we have people trading daily bars, people trading 4-hour bars, 2-hour bars. And what the bias indicator does is it automatically configures your 3 higher time frames. So if you're trading a 3-minute, the second higher time frame is going to be 9-minute, and your third higher time frame is going to be 27 minutes. If you're trading a tick chart, it's going to defer to the closest fib and then take your 2 higher fib numbers, which is what happens on a range. This is a 5 range. The next higher time frame is an 8, and the next higher time frame after that's a 13. And the same with a Renko. So it has absolutely nothing to do with what you're trading. Thank you, Brett. Yeah, I don't think you can trade without them. Now, you know what? On a given day, like today, it had 1 trade. Some days it has 2, and sometimes there'll be no trade for 2 days. And that's the precision of the system. You can either decide whether you want to trade with sensitivity or specificity. We want to trade with specificity. We don't want to give any independent variable away on any trade. If they don't align for us and set up for us, and the market is essentially a chop market where there's not a high probability of follow through, you want to stay out. So when there is no alignment and there is no transition zone, it's because you're unlikely to get a winning trade. When it does set up, it can give you 2 or 3 trades in a day. So it's variable. But you're probably going to get 5 to 7 trades a week on average, especially now in the fall. Denise, it's always at the end of the candle. I believe that taking a trade intra-candle is sort of like taking a trade, like the market's expressing itself in market structure. I can't tell you the number of times where you'll have a candle come down 7 ticks, then not close to the downside, and then close 1 tick to the upside. You have to let the candle close and then take the trade 1 tick below. And remember, it doesn't make any difference whether you're trading time tick, Renko, whatever. The top of a bar acts as a small area of resistance to the upside, and the bottom of a bar acts as a small area of support to the downside. So you don't want to take a trade until the candle breaks the low of what we call these formations. When we applied for the patent for our NDT, we had to define formations. So the formations are time, tick, Renko, range, Kagi, open, high, low, close. It's got to break the low for a short and break 1 tick above the high for a long. Mark, what you're looking at is our algorithmic. We don't have the system posted yet on the transition zones. So the transition zone winners have a much, much higher win percentage than the algo trades. The algo trades are great trades, but what we look at for the algorithmic system over the course of a year is to bring you in a return on investment of 100 to 200%. Now you can't get a better investment than that in any financial instrument that you don't do anything with. I mean, this just trades for you, just like the transition zone. But the algo system trades 6 markets. It trades bonds, notes, gold, crude, the E-mini, the NASDAQ, and the S&P, and the E-mini. I mentioned that twice. So, and we're moving into more markets. So that is not going to trade with the precision of the transition zone. And we don't let the algo take the transition zone entry. We've split that entry off because it has such a high win percentage, and we've created a unique entry with that. If you want to include that, you have to. It's not to charge you more money. It's simply to provide a single configuration that gives you a win percentage of 85% or greater. And very few transition zones fail. I can tell you. Only on Ninja, Brian. Listen, it'll trade any session. Now, the only thing that we have not tested it on the Forex, and I don't want to tell you we have because we haven't. And I've done a lot of work on the Forex, and the bid-ask difference is always a problem. When you break 1 tick below the close of a candle of any formation, you're usually down a pip or 2 because of the spread. So we have to look at that. So I can't tell you that it trades as efficiently as it does on the Forex until we've looked at 2 years of market replay data. It's going to work just as well on stocks, but because that 1 penny isn't going to be a problem for you. But on a Forex market, it can be a little bit more of a problem. And I think we found a way to beat it, but we haven't really tested it completely. So I don't want to tell you that it works until we're sure that it does. Mitchell, it does not. We have already optimized the ATM via 2 years of market replay. And what we have found is the number of trades that retrace on crude, 14 ticks, is uncanny. When we did that, this is based on prior 2 years of trading. That's why we set the trailing stop at 15. I can't tell you why 14 seemed to be a magical number. I don't have any idea. But that's how we came in. We came back with the 15-tick trailer. If it seemed like that magic number was 11, we'd have an 11-tick trailer. But the magic number is 15. So it's 14. So the trailer is 15. That's going to get you a big pullback. But a lot of those trades are then going to continue on. I just can't tell you why that is. The stop on the E-mini is 6. You risk less. You're going to make less, which makes sense. But you're going to get a lot of singles and doubles on the E-mini, and you look for the home runs on crude. But you get them both anyway, so you don't have to pick a market. I like range bars, Brett, because I know where the close is when it opens. And if you look at, we have a range maker here. So on the right edge, I can see that right now, the close on the E-mini, if it closes to the upside, is going to be 21.28.50. And if it closes to the downside, it's going to be 21.26.75. I already know that. So let's say I didn't have the NTD and I don't want to go into our trade management platform, and I wanted to use the Superdome, and let's just say I was going to take a long trade here. I would set the entry at 21.28.50 and know I was going to get in 1 tick above the close by putting a buy stop order in. That's why I like range. Now the NTD, I'll just show it to you really, really fast because I want to show you how I can't do it here. Hold on 1 second. I'll show it to you really quickly. I can't do it here either. I don't know why I'm locked out of it. Hold on a second. Here it goes. Nope, I can't do it. Hold on, I'll show you. I just don't want to. I don't want to get too far off of this topic, but I'll show you. This will only take me a second, but I'll show you how easy it is to trade. I'm not going to enable it, but I'm just going to show it. No, it's not letting me enable here. Oh, I know why. You know what? I'm not hooked up to any data feed. So I'm not, but the NTD allows you to buy an up close or sell a down close. So if you're trading, say, tick, you don't know exactly where that up close is going to be, it will execute with lightning speed that close 1 tick above the close of a tick bar or 1 tick below the close of a tick bar. It's very, very, very fast to get you in. No, you can definitely trade it manually. Those are going to be the 2 options you have. Denise, it always enters on a limit order. No, I'm not demonstrating the algo trading. The algo trading is much more complicated. The entries are much more complex. They don't have the predictive value of the transition zone. But if you just want to sit back and do nothing and take a set amount of money and have a great chance of getting a 100 to 200% return on investment for the year, that's what the algo system is for. If you want to make a living, it's tougher on the algo system because you're not. I want to be honest with you because I could tell you anything I want, but that's the reason we post the winners and we post our performance because I don't want to mislead you. We'll be posting the transition zone. In the transition zone, you'll see rarely takes a loser, and some of the winners are gargantuan. So if it takes a loser for every 6 or 7 winners, or 7 or 8 winners, it dwarfs, the winners dwarf the losers, and that's what makes you so much money, is that risk to reward. No, Michael, that is not a new indicator, although we can send it to you. I know you own the system, I think. What it is it's just a line that tells you that the algo for the transition zone is thinking now. That's all. Because you see, if it was an indicator, we wouldn't have it repaint. And you'll notice on this whole chart here, there is no line. Now, we made 9 ticks on this reversal. So this is a 20-tick algo. There's no transition zone line here. Because once the transition zone ends, the line disappears. And the line moves to the new transition zone. And once that transition zone disappears, that line disappears. It's simply the algo system turning on and off. And it's to let you know that it's on and thinking, and to give you the heads up. It comes with an audible alert, too, so you can hear a beep if you're not near your computer and you want to run and take a look. The reason, Brad, is simply based on volatility. The crude oil has much greater volatility, so we trade it with an 8. The E-mini has much smaller volatility, so we trade it on a 5. Bonds and notes, the algo system trades on a 3 range. It just has to do with the volatility of the instrument, the average true range, the ATR, or the average true range. Well, you know, what we've looked at, Mark, is it's going to give you about 3 to 5 a week. And it can give you as many as 7 or 8, or as few as 2 to 3. It all depends upon how the market trends. If your long-term time frames do not align to the downside and never break support to the downside, you're never going to get this pink color. And that's when you don't want to trade. These are when the highest probability trades take place. You know, everybody says you always trade with the trend. Believe me, that is the truth. When you trade with both of your higher time frames, and you don't have to keep watching those higher time frames. You don't have to watch the moving averages and market profile. And the system does it for you. When you get an entry, that's when you get it to run. And that's really the key to the system. When you see things like this, right here, you don't have that dark pink. This is a very mild down bias, but no entry. You can see you have nothing but chop here because the system isn't defining for you. Now, I took this trade, I made 11 ticks. This was a risky trade. But when you don't get that color, and I took this roll because it was a roll into the trend and I made 11 ticks. You always want to trade into the trend. And that's really, I have found the key to being successful. And what we look for on our discretionary system is a trade, if I can find it here. See, that was a loser. I tried a counter trend trade, and I lost it. And I came right back, and it was a winner. We look for a channel into the trend. And I'm getting way off base here. But here's a rising channel into a long bias. And it gave us a first target. It made us $100 right there. So that's really the key, is trading with the trend. Every now and then, I get antsy, and I took a counter trend here, and I'm trying to see why I thought that was such a great trade. And you have to go to the right edge, and I just don't know. That was just a really bad trade. And you can see it blew right up in my face, and it went right through the stop. You know, you know what, Ramo? What we have found are correlative markets. For the 6J, the 6E, and the 6B, they all have correlative markets. You just have to find them. There are markets that correlate in either the same direction or the counter trend direction for every market that's out there. Because you have to remember that no financial instrument moves in isolation. You're not going to get a selective move on. Now, sometimes, listen, occasionally they do. This is the problem when you trade with specificity. Sometimes there'll be some, like today, we're going to add two things in the trading that's going to make it really very unique. But today, there was a rumor out that Janet Yellen was going to retire. And I saw it cross the data feed. And the E-mini took this 5-point move straight up. It didn't have the quant lines. It didn't have anything. And that was because people just started diving into that market selectively based on that small piece of information. You're just not going to get that trade. But if you want to wait for the trades that have a very high probability of winning, then you wait for the quant lines to roll in your favor. Now, in a live chart, all three of these were red. When you recalibrate, the way the Ninja platform works is when you close it and open it, fractal indicators recalibrate and they move to the right. And I don't want to get into a big thing about why it does it, but they just do. But that line wasn't yellow, it was red. And if you want those trades, you just have to wait. And that means there are going to be certain trades you cannot get. So let me just try to wrap up here. The NTD is included, Denise. You sure can, Richard. Yes, you can. All right, I'm going to give you all the prices and everything. Hold on one second. I'm just going to scroll down. If you have any other questions, I'm going to have. Now remember, you only trade this with 2 contracts, so your risk is small, and you can trade it with 4 or 8 or whatever. But the amount of money that we recommend is 2. Now we charge $798 for the transition zone. It's normally $14.99. This is not the automated trade. It's the one that you have to take on a discretionary basis. But you get the NTD, and I'm going to make the call in the trading room. So what it does is it locks you into the trading room until you really learn it. And if you purchase it, I'm going to hold a couple of webinars to teach you what all the parameters you need to take it on a discretionary basis, even if you're not in the room. For $16.99, you get the automated transition zone entry. You don't have to be there. It'll take the trade for you. It'll manage it for you from start to finish. If the modified 15 goes yellow, it closes the trade. If you hit upside resistance, it closes the trade. It's going to do everything for you. And for the first 5 who purchase, they get 3 months in the live trading room for nothing, 3 months of the NTD for nothing, weekly didactic sessions, and they're really good. I have to tell you, I didn't have one this week because of just scheduling issues, but they're on Wednesdays at 1, and sometimes they go 2.5 hours. Plus, as we add new markets, you're going to get those markets. Right now, we're on the E-mini and we're on crude. We're going to add this to the to gold and to the NQ and move from there. You get all of these you're grandfathered into all of these additional markets. And it's good through Sunday at 5 p.m. And what we're going to do is we don't have a web, I mean, it's not up on our website yet. So what we're going to do is Rory's going to send everybody in the room a link. And if you'd like to sign up, we'd love to have you. I'm telling you, it's going to make you money. I don't know what else I could say. I mean, we're really, really reputable, and we don't mess around. And I'm in the room every morning grinding it out. We're www.RightLineTrading.com. Email's info@RightLineTrading.com. And our phone is 855-765-6681. And we configure the whole system for you. Whether you're on a server for the automated algo and that server is located in Chicago. So it's centrally, it's not in our office because we're in Florida. This system, the server that sent out the signal is in Chicago, centrally located in the US. So it actually comes into this office the same time it comes into your computer. So I don't have an advantage in getting an entry. If I get the entry, I expect everybody else to have it because I'm sort of on the East Coast and I'm not in the central part of the United States. So if you have any other questions, just give us a call. I tell you, I call the trades in the room. If you want to opt for the less expensive, I get them. And here's the other thing. If you're in the room on the discretionary and I see the algorithmic take a trade, I announce it. Because what you're going to see go up is you're going to see the ATM go up. Because we trade with the with Chart Trader. So if all of a sudden I'm talking and right in the middle of what I'm talking, you see a trigger that for some reason I missed, you'll know the algorithmic took the trade. I'm going to see the trade. And usually you've got time to take it yourself. It usually doesn't happen because what it does is as soon as the bar starts to the downside, it sees the potential for a trade and it triggers the entry. And then the candle has to form all the way at the bottom. And if it doesn't, it cancels your trade for you. So it gets into the candle. It gets you in early. And remember, you're filled in the order that you get in. So this system gets you in early. So you're early on the waiting line. Now, believe me, I know the markets are never fair, but to the best of our ability, we get you in quick. And the signal is going to be in your computer. We don't trade, unlike Lee, we don't trade the news. We avoid the news. So we wait for the market to settle down. We wait for a trend to establish, and then we take it. And we turn the algo off on big time news that's going to make the market stutter. So we do exactly the opposite. And Lee's system is great, but he's looking to capture a different kind of mood than trade than we are. That's all. No, it's not an extra cost if you're one of the first 5. You're in the room for 3 months for free. And after 90 days, if you haven't made really nice money, just call me up because I take these trades in the room every single day. And we had a nice trade today. And I think the system will pay for itself. And I'm not a big seller of anything. I'm more of the trader, developer, and Rory's more of our advertising guy. But I mean, this is a very, very lucrative system, and that's why we split it off. Yes, Brian, the indicators are included. The room starts at 8:45 in the morning, except when we make announcements. Like tomorrow, if you look at Forex Factory, you're going to see there's major news tomorrow. So we're going to open the room early. But you will always get an email. Tomorrow morning at 8:30 is core retail, PPI. So we're going to open the room at 8:15 Eastern. And we're going to all be there at 8:30, and we're going to hope to get a nice move on the ES, maybe even a transition zone. So normally we open it at 8:45, except when we see something really juicy that maybe we can latch on to in the morning at 8:30 a.m. So listen, I want to stop because I don't want to run too far over. Rory will send you the link. Any questions, anything, we're here. We're always here. We live here. And we all have bugs here. And we all have campfires here. So we're always here. We're very out in front. And we're very accessible. And if you have any issues or problems, let us know. So listen, thank you so much for giving me all your time. But I just want you to see the methodology. This isn't a closed black box system. This isn't a system-generated entry. You haven't got a clue why it's being generated. You're taking a small retracement into a huge trade, into a huge trend that's developed on your 2 higher time frames. And that trend, when it hits resistance to the upside or support to the downside, is going to reverse and move back into the trend, and you're going to get yourself a nice winner. The key, though, is you make money on every trade. You go for a single on every trade, and if you do that, that's when the triples and your home runs come. And that's what the transition zone is meant to do. On a 15-tick trailer, you're going to get those home runs. If you have to take two singles and then get a home run, I mean, a home run can be 50 or 60 ticks, and you're only taking 2 contracts, not 4, not 6, not a lot of contracts. So listen, everyone, have a great afternoon. Thank you, really. I really appreciate it. And hopefully we'll see you in the room. So take care. Have a wonderful evening. And no matter what you do, I really hope you're profitable and make money. Trading futures is hard, but it can be profitable. So take care. Thank you, guys and ladies. Thank you very much. Bye-bye.